Hello and thanks for joining me today. My name's Lawrence Coyne, and like many of you, I'm an ex-associate of Jungle Friends Primate Sanctuary. I'm an ex-volunteer, an ex-employee, an ex-donor. This video is the first of several that exposes questionable behavior at Jungle Friends. Specifically, this video involves the property owned by Jungle Friends that was sold to Sarah Q. Smith. Now, Sarah Smith is a board member as well as a board secretary. We will discuss possible self-dealing and possible misuse of JFPS funds. Okay, so a little history. Excuse me. Back in 2018, Jungle Friends received a $100,000 grant toward the purchase of this 6-acre property. It was intended for hurricane shelters and staff housing. It came to be known as a Fixit. Kari Bagnall described it as a money pit. Jungle Friends bought it on December 7th, 2018 for $87,500. The plan was to get the county to include it on Jungle Friends' special use permit, but that never happened to the best of my knowledge. Now, Sarah began to rent the property in 2019. Now, I remember her denying that at one point, but this is the background check right here that showed that the Smiths were not only there, but receiving mail at that address as of October 2019. Why deny it? Well, let's take a look. Well, there were some challenges with the lease and some shady solutions. Instead of a lease and rent payments, Sarah and Shanna paid their rent by making charitable donations to Jungle Friends. I know, that's kind of strange. No pesky Florida sales tax to worry about. No fuzzy revenue streams for the IRS to be concerned about. Nice and simple. Shannon Smith also bartered extra volunteer time to cover the amount, about $500 a month in rent. No problem, assuming they reported it as income, but whether they did or not doesn't concern me in the slightest. I don't know if a lease was ever signed. Also, it has been reported by multiple sources that Jungle Friends was purchasing things at Lowe's for home improvement at the benefit of Sarah and Shannon. I think it came up to somewhere around $20,000. Now, they were supposed to pay it back, but they were using Jungle Friends credit cards and Jungle Friends sales tax permit. So, again, don't have to worry about those Florida pesky sales taxes. Nice if you can get it. Now, I don't know how it went from a lease to a sale, but eventually in September of 2020, Sarah bought the property for $94,000. Now, here's the property appraiser's notice on it, and it says that it is a qualified sale, which means that it is a fair market price. Okay? That's going to be of interest later. Now, they bought it in spite of the fact that Sarah had a conversation with a real estate attorney advising her not to do it. Excuse me. And for very good reason. But there's even more. Take a look at this. Jungle Friends issued the Smiths a $54,000 15-year mortgage. That's the deed. $54,000. Payable no later than October 1st, 2035. That's 15 years. Borrowers, Shannon Smith and Sarah Smith. Lender, Jungle Friends Primate Sanctuary. Now, is that normal? Well, actually, no, it isn't, and for very good reason. First, because it's against Florida law. Statute 617.0833. Loans may not be made by a corporation to its directors or officers. A loan made in violation of this section is a violation of the duty to the corporation by those directors and officers participating in it. The obligation of the borrower with respect to the loan is not affected. Okay, hold your horses. This is not one of those go directly to jail, do not pass go situations. It seems, if enforced at all, it's by the Florida Department of Agriculture, who could seek fines as well as a suspension or revocation of their Florida license. So that's a big deal, but again, if enforced at all. Now, it's also a big deal with the IRS. The IRS considers Sarah, who is a member of the board of directors, a disqualified person, or sometimes called a interested person. Transactions between Jungle Friends and a disqualified person are considered self-dealing. Now, what's self-dealing? Well, IRC, or Internal Revenue Code 4941, provides that the term self-dealing means any direct or indirect furnishing of goods and services or facilities between a private foundation and a disqualified person. Now, that's going to include mortgages. That's going to include purchases of real estate. And it further goes on to give examples of what self-dealing is. And here's three of them. One, the sale, exchange, or leasing of property. Well, we got a $94,000 sale of property, so there's one. Lending money or other extensions of credit. We got a $54,000 mortgage. There's two. Transferring foundation income or assets for the use or benefit of a disqualified person. There's those trips to the Lowe's. That makes it a trifecta. We got three. So as far as the IRS is concerned, this could very well be self-dealing. Now, for the purposes of the IRC 4941, it does not matter if transactions benefit or harm JF for them to be considered self-dealing. But there are some exceptions. For instance, if the transaction is at least as good as a transaction with anyone who is not disqualified, this is called an arm's length transaction, then it may not be self-dealing. And we took a look at that appraiser's report that said that it was qualified. So, would think that, okay, it's at least as good as a transaction with somebody who's not on the board of directors. But there's a second clause to that, and they're connected with the word and, so both have to be true. It would be a severe economic hardship for Jungle Friends to sell the property to anyone but the disqualified person. How could that be? Who does it matter that you sell it to? Let's take a look at that. This is a spreadsheet that lists the revenues and expenses of Jungle Friends from 2015 to 2021. Now, if you take a look at the last 3 years, 19, 20, and 21, Jungle Friends has been operating in the red, significantly so. And it appears to be trending. Given these numbers, selling an unnecessary asset seems prudent. Financing most of the sale? Probably not so. But JF is free to make bad decisions. No law against that. But not where the board secretary receives a significant benefit. That's where we get into self-dealing. And that's a whole different horse of a different color. That didn't work well. Forget about it. All right, so let's move on. So what's a possible penalty should the IRS rule this sale as self-dealing? Well, there's an excise tax. IRS does not call them fines. They call them excise taxes. An excise tax of 10% of the benefit received is imposed against the disqualified person. That's Sarah. There's an additional 5% excise tax imposed for any director who participated. That means that they voted for it. All parties will be jointly and severally liable for those taxes. I love that term. That basically means that the IRS can try to collect it from everybody, or they can just go to whoever's got the deepest pockets, take it from them, and let them wallow it out on their own. But that's a possibility. Now, all of this is unless the partition is not willful, voluntary, or intentional. And heck, how do you sell a $94,000 property, finance $54,000 of it, and it not be willful, voluntary, or intentional? I'm sure that somebody will figure out a way to make that happen. So was Kari Bagnall being willful? Here's some examples the IRS identifies as proof of willfulness. These are things that they have gone to court and successfully proved. Signing a return known to be incorrect. Failure to supply an accountant with accurate and complete information. Both of these could be used as proof of willfulness. So, let's take a look at Jungle Friends annual IRS 990 report. Before we do, let's answer a few questions. Basic. What is a Form 990? The IRS 990 is a required form to be filed annually by any 501c3, like Jungle Friends. Basically, it's their version of our IRS 1040. What is a Schedule L? Well, it can be included in a Form 990, and its sole purpose is reporting all transactions between a nonprofit and a disqualified person. That's all it does. That's how serious the IRS is about transactions with a disqualified person. Now, is Jungle Friends aware that there's even such a thing as a Schedule L? Oh, yeah. Yes, they are. They filed a Schedule L in 2019 and 2020 on a different matter. You'll be seeing it in a bit. But they're aware. When is a transaction to be reported? The year that it happened. Now, if it's a loan, it has to be reported each year that it's still in effect, right up until the time that it's paid in full. Okay, so what are we looking for in Schedule L? Well, the transaction is in two parts. There's the $94,000 sale of the property, but there's also the $54,000 loan. So we should be seeing two entries in Schedule L, $94,000, $54,000. What else are we looking for in the IRS Form 990? Well, when a corporation sells real estate and finances a portion of the sale, there will be three entries. One is in land, buildings, and equipment. This is where that $94,000 property is listed. So it needs to be reduced by $94,000. JF no longer owns that property. It belongs to the Smiths, mortgage notwithstanding. In gross amount to sale of assets, there should be about $40,000 indicating the down payment that the Smiths made. This is cash received. And then in assets receivable, which is really nothing more than an accounts receivable, there should be an entry of $54,000, which is a loan. That accounts receivable is an asset. It's not immediately liquid, but it's an asset nonetheless. So, first thing we're looking for is $94,000. We're going to look on Schedule L, Part 4. And here it is. Okay, now we see an entry of $21,842, employee compensation. And I'd mentioned that earlier, that Jungle Friends had filed a Schedule L before. And this has to do with an employee who is also the child of one of the directors. And I've blurred out their names and relationships and all that sort of thing because it's not pertinent to the discussion and nobody needs to know. But what isn't there is $94,000 for the sale of that property, and it should be there. That's a big deal. That's a big omission. Next. Now, here we're going to be looking Schedule L again, Part 2. And we're going to be looking for a loan to or from a disqualified person. In this case, it would be in the amount of $54,000. And here we are, Part 2. Nothing. Nada. Zilch. That's wrong. That's way wrong. Let's move on. Okay. Now we move into the 990, the nuts and bolts of it, and we get into assets, land, building, and equipment. Now, the beginning of the year was $882,000. Now, it depreciated by $23,233. When we put the $94,000, which should be taken out of that account, we're expecting to see a year ending of about $765,000. Here's 10C. $858,866. That $94,000 is never taken out. Let's move on. Then we're going to be looking for income from sale of assets. This is a down payment. We're expecting $40,000 to be in Part 8, Line 7, and here that is. It's not $40,000, but it's close to it, $36,403. Is that it? Well, the answer to that question is yes, and I know, and I'll show you in a little bit real simply why I know. But that is the down payment that the Smiths made to Jungle Friends, and that is the only thing that is mentioned on the 990 concerning this transaction. That is the only thing. So we look for assets receivable from a disqualified person, and that would be in the amount of $54,000. We're going to look at Part 10, Line 5, and here that is. And nothing, nada, zilch again. 5, 6, and 7 are all accounts receivables. It could have been placed in any of those. It wasn't placed in any. Basically, what we're seeing here is that Jungle Friends would have the IRS, they would have their donors believe that they still own that $94,000 piece of equipment, that piece of property, that they do not have a mortgage that they wrote for $54,000, and that they received some $36,000 for the sale of some asset that was either land or it was equipment or it was a building, a shed maybe. Yeah. None of that's true. But before we go any further, let's take a real quick look at 2021 because something of interest came up. I also got the 2021 report, and then lo and behold, the loan shows up in Schedule L, $57,597. Well, okay, a couple of questions. Where's the $94,000? The purchase price. It's not reported anywhere. And $57,597, it was supposed to have been $54,000. That's what's on file with the county clerk. Okay, all right, but we do at least have it reported. And then if we go down, about that. If you take the original purchase price, $94,000, and you subtract the $57,597, you're going to get $36,403, which in 2020 was the amount of money that showed up where we expected to see the $40,000. That definitely is the down payment that the Smiths made on this property. We also see the assets receivable is showing up now. In 2021, year-end balance was $56,218. And finally, we're looking at the assets, land, building, and equipment having been reduced properly for about $770,000. Okay. Finally. Well, why did it skip 2020? All right, what do I infer from this? Well, first, there was a second promissory note not recorded with the county. They don't have to record it. On record was $54,000, but reported is $57,597. So that's $3,597 also loaned to him somehow. Don't know why. I also know that the accountants were unaware that the Schedule L transactions had not been properly disclosed for 2020. Now, how do I know that? Well, because this is a very reputable company. These people, under no circumstances, are going to risk their reputation by intentionally sending incorrect information to the IRS. And they're not incompetent. It's not like they didn't know about the Schedule L. They got bad information. They became aware of the Schedule L issue in 2021 or shortly thereafter. How? Well, I've got my theories, but they're just theories, so I'm not going to go into it. The 2021 report reflects then what should have been reported that year, notwithstanding the 2020 report filed incorrectly or filed correctly. The 2020 Form 990 was never amended. Now, why do I think that? Well, because I asked for it. The only reason that I have the 2020 990 and the 2021 990 is I went to Jungle Friends and I asked them for it. They're required by law to give it to me upon request. When I found this discrepancy, I asked them for any amendment to the 2020 990, and I got crickets. Never said a word. And that's because there's not one. They elected not to amend it. So you might ask, I certainly did, shouldn't the accounting firm advise the IRS that a mistake was made? Surprisingly enough, the answer to that is no. Let's get into it. There is a Treasury Circular 230 that directs the tax practitioner what to do if they discover a mistake on a filed report. They are to advise the client of the mistake, suggesting a suggesting a proper action, and inform them of possible consequences. The client decides whether to amend or not. The tax practitioner does not. The tax practitioner must not attempt to correct the mistake on the next year's filing, but report it as it existed at the end of 2021, which they did. Client accounting privilege does exist, and the tax practitioner may not divulge any information to anyone, including, believe it or not, the IRS. Is that what we're seeing here? Information withheld from the accounting firm? I don't know. But if it is, it would suggest self-dealing. Now, why would Kari not want these transactions to show up on her Schedule L? Well, it could be a mistake. Okay, all right, that's a pretty big mistake to make, but the chances of making a mistake here are not zero. It could be a mistake. She might not want the IRS to see it. Duh. Also, she is sending out grant requests. Foundations frown on 501c3s that report flagrant self-dealing transactions. That's bad enough to nix any grant. Might be other reasons. I don't know. One last thing. In a 2019 conversation between Kari Bagnall and Statute Smith, they discussed a misunderstanding on the proposed rental payment. Here's part of that conversation. Kari Bagnall. But the original agreement that we talked about at the board meeting was that Jungle Friends would purchase the property and pay to get it livable. Process that. They had a board meeting about buying a property and fixing it up so that a member of the board could move into it. Self-dealing? Okay, and any upgrades that Sarah and Shannon wanted to do, like brand new appliances, upgrading flooring, gas versus electric, etc., they would pay for out of their own pocket. The realtor said the property will rent between $800 to $1,200 a month. Now Bagnall continues, but Sarah and Shannon would pay only $500 a month, which is what they are paying for their mortgage right now. That is how Sarah and I came up with the $500 figure in the first place. And then the other $500 a month would be offset by Shannon volunteering, working at Jungle Friends, like he always has, but adding some more responsibility to his role as in maintenance and OSHA. Oh my goodness, is that a sweetheart deal? So I ask again, were best friends forever Kara and Sarah acting willfully? I know what I think. Was this an act of self-dealing or a simple arm's-length transaction that Kari would have offered to anyone that came knocking at her door? Would she loan an outsider $54,000? You decide. Well, again, thank you for joining me. Let me know what your thoughts are. Got any questions? Be happy to field them. The next episode I'm planning is, well, the working title right now is, Where are the new bird cages? Heck, where are the birds? Don't believe the cat. She lies. Yeah, you see what I mean? Okay, so stay tuned. I got to take care of this cat.